Okay, welcome to the video section of looking at how to employ different types of trading strategies when you observe market flipping, spoofing, or layering. And we're going to be looking at a few of the strategies. First, annotate them, and then we'll look at an actual example that happened in the Bund contract. So firstly, let's just have a look. As you can see, the video will be looking to the right hand side over here, which being the Bund market. Now, firstly, let's look at really explain through annotating on this ladder what the various trading strategies are, and then we'll look at one of these trading strategies in real time. So firstly, the false offer block. Now, the false offer block is really it's the objective of the layered spoofer is to create an artificial offer in the market. So what you're trying to do over here is all of these orders over here, they might be larger than average and might seem larger than all of the bids. So for example, this could be 400 lots, 400 lots, 300 lots, 400 lots, 400 lots, 400 lots, and 400 lots at every single price over here, over here, over here, and really representing that's almost twice as large as the offer. As large as the bid. And if you refer to the slide, we've mentioned that the objective of the trader is to observe this false offer by identifying the lack of relative trading activity going through on the bid. Bids are being pulled until there is a liquidity collection point bucket. So what we mean by that is, as the market offers down, all of these bids are not really real. So out of 313 lots, only say 50 lots get traded. 50 lots get traded. So this gets pulled. Most of the orders, the buy side orders, are pulled. So they pull the order, they pull the order, they pull the order, they pull the order, because the market is seeking an area where it'll find liquidity, where the market will start auctioning again. So when the market isn't auctioning at per price and there isn't that two-way exchange, the market can really continue in one direction at quite a rapid rate whilst all the buy side orders get pulled. And then the trading opportunity is once all the pulling has happened, and what I mean by pulling is when you have a certain size but not all that size gets traded and only a very small fraction of that size gets traded, that's effectively what you call pulling the bid. So the market trades all the way down as the offers are looking large, but they're not, might be real offers, but it's more the bids getting pulled. And as the market trades down and it offers down, offers down, offers down, offers down, and then when it finds that point where there's all of a sudden two-way flow and the market is actually trading, so all of a sudden you see, for example, over here, this 178 lot, the market trades the entire 178 lot, then an iceberg comes in, or a time slice order, or some type of reloading pattern or absorption type pattern where the market keeps on now reloading. That is the opportunity on a false offer block type of a trading strategy, where you start joining the buy side and you look for the market to actually trade out the entire area that was pulled. And that's really your trading strategy on a false offer block. Is you wait until the prices stall, until there's two-way exchange after the pulling of all of these prices over here. And then the converse is true on a false bid block, where the market looks artificially stronger on the buy side. The offers are getting pulled as the market trades up until it hits an absorption wall, and the market trades in two-way flow. You join that absorption zone and you wait for the market to trade back that area that it hardly auctioned, because the market likes to auction areas thoroughly, on the balance of probabilities. So that is effectively, two of the trading strategies, being the false offer block and the false bid block. Then you can also get the liquidity hunter, which is a fairly similar play to both of these, where the liquidity hunter really is trading through the market until again he finds an area where there is liquidity and the market exchanges, and when that liquidity is found, then the market can start trading back that unauctioned area. Now we'll be looking at a specific flip example where we're looking effectively at a type of lone ranger trading strategy when you see a large order coming onto the order book, or a potential flipper or potential spoofer, where we'll be looking at where they come in, say, one tick from the market price. So say in this instance at 167.43, they put a large order in over here, so they can so people try and execute some front run orders, but those front run orders are met by a passive buyer on the other side, and that passive buyer on the other side of the market is effectively loading up on liquidity, and then this order is going to get pulled, and then the market trades up a couple of ticks, and it's just working. This algorithm is just working a small little range, and you want to trade within that, taking 1 to 3 ticks. So let's have a look how this trades accordingly. So we're watching over here. As we said, we're looking for a Bund flipper. It's the order flow type is market flipping, layering, and spoofing price patterns are part of module 10. What we're looking at, the pattern type that we're looking at is a trading with the flip. So we want to observe where the market will be flipped. Okay, and then the trading strategy, we enter trades on the opposite side of the large flip order. So if we see a large order, we're entering on the opposite side of the large order because we feel that order will be pulled, and then once we get filled on our order, as it gets pulled, we exit our order for a quick leverage scalp. The ladder market environment, what we're looking for is a very low liquidity environment, type of blippy price action, not much auctioning going through until it finds that area where it does auction. So low auction, thin, low liquidity, where the market just blips around. This example is actually 10 minutes after a Jackson Hole Janet Yellen speech, so the market was in a bit of a volatile session, but was still trading within range and was actually blipping around with not much action. The risk management, you're looking at 0 to 3 ticks because you're trading just on the opposite side of the flip. If it starts going against you, you get out immediately, and you wait until you find that liquidity bucket where there's a two-way flow and absorption. And your reward management is 1 to 3 ticks as you trade within where the algo is working certain range. And the flip usually works a very tight range. In the bunds, about 3 to 4 ticks. DAX sometimes about 10 ticks, 5 to 10 ticks. So we're looking now for this large order, and let's have a look how this plays out now. Okay, so we're watching, and you'll actually see some execution going on here on this trade over here. So I want to bring to your attention in a little moment when we see a large order come through on the order book. So you can see at the moment you got 39 lots, 120, 211, 170. So really the average size is about 130 lots, and you can see on the buy side the same. We're between 100 to about 250 lots. So first my eyes are alert to the average bid size. We do have a very large over here, so this is a bit of an anomaly order over here, 167.50, that should be keeping an eye on a potential front run strategy if the market were to shift there very quickly. So we're still observing this, and now you can see at the moment, you can see there we go. So you see immediate execution at the 39s, a large order. So this market just blipped down. Then all of a sudden, a 526 came to the market whilst it blipped down over here. So potential flip on the play. So you go on the opposite side of the order. Now the reason why you've identified this as potentially not a front run order is just the nature of the auctioning activity that's going around in the market, and low liquidity, fairly thin conditions, and blippy price action where markets not trading, not auctioning at specific prices. So now let's have a watch of this, and let me actually okay, we're watching it twice speed. So you can see now so we just got filled at the 39. So as it got filled at the 39s, 200 lot got taken. So 200 lot got taken, but then the market reloaded itself. So it's reloaded. So potential very intraday time frame at this price, a particular type of iceberg pattern or volume slice pattern, absorption, overall absorption pattern going on here, and the market has potential 514 lot non-genuine order that we're watching over here. So we're keeping an eye. It gets on reloading. You're watching this. It keeps on reloading itself. Keeps on reloading at the 39s on the buy side. So we're watching it again. it gets taken out, gets reloaded. So add an extra. So as we start observing this reloading at the 39s, start adding a clip. So we've been doing in clips of 2. So built a position of 8 lots at this moment. So there we go. So you see hardly anything got traded through. The 500 lots got pulled and the market has flipped towards the other side. So again, just to summarize, you notice an anomaly large order after the market's blipping around. You notice now what you want to see when you see an anomaly large order. You don't want to see, if it were a front run, the market would keep on offering over as people start front running the large order. But what actually happened, the moment there was that large order, the 39s kept on reloading on the buy side. So that is, the nature and the requirements of the flip pattern is when you see the large order, just below the large order, or below, prices below the large order, you want to see a reloading of the prices on the opposite side of the large order. So we're watching here. So we've gone on side, immediately took out, put 2 clips of 2 to get out half the clip, so one at 1 tick and one at 41s and then 40s. So we're watching over here now. Again, we're trading at 41s. We now still got our four lots on. There we go. Now you see, now it's just flipped, so it just traded out towards 42s, and then another order has come on the book. So now this is on the opposite side. So we had it on the offer, now on the buyer side. Now we want to see if this is a flipper that's come into the market. Potentially now we want to be trading on the offer side if we see the offers reloading themselves. So if all of a sudden the offer starts taking out the 42 and it reloading itself, you could see a flip in the other direction. So let's see how this now plays. So we're watching over here. We're trying to get out of our trade. We start going short to go against the flip, and there we go. So that 1,000 lot that was non-genuine, now we're flipping the other way. So you've just observed with the 500 lot getting long below the 500 lot when they were shown on the offer. When there was that 1,000 lot on the bid, you're then getting short to start exiting on the other side, and then you're observing these patterns. So we're wanting to see if we can see any more flips over here. We can see any more reloading or absorption type patterns, and over here there's just a little bit of a scalp. And as we can see, in that little moment, the flip has disappeared, but there was an opportunity to make between those 2 flips, between 3 to 7 ticks in a very short period of time, just working an order book pattern by observing thin conditions, low liquidity conditions, and seeing an anomaly large orders come in and seeing absorption on the opposite side of that large order once you're waiting for the flip to happen. So just to summarize, we've just looked at the type of Lone Ranger play. I explained right at the beginning of the video what a false offer block looks like, what a false bid block looks like, and then also a liquidity hunter. And effectively what it is just when the order book is not really representative of the true state of the orders, and the market will trade in the direction until it finds liquidity, and then you can scalp on the opposite side of that liquidity bucket.